let's turn these others off. Okay. And let me turn that off. Okay, so right. Okay, so what John is saying is here's the activity since. Okay, let me just sort of fill the gaps. So I was talking about the long-term picture: 6-year cycle, no 6-year cycle. Okay, whichever analysis we're looking at, all of my analyses agree that March of 2009 was a trough of the 18-month cycle, and I'm just going back to show that to you. Okay, there we go. March 2009 was the trough of the 18-month cycle. Then in July of 2010, we have another trough of the 18-month cycle. I have an interesting alternate analysis proposed by Jose, who's with us today, which shows August as an alternative to that. But that's quite interesting. I'll show you that last, I think. So we've got an 18-month trough in July of 2010. What has played out since then? Well, let me quickly draw it here. Since the 18-month trough in July of 2010, we've got a beautifully straddled trough again, a 40-week straddled trough in March of this year, March 2011. You can see it's fairly straddled, fairly symmetrical price development, and all that kind of thing. Now, this analysis that I have on screen at the moment proposes a 20-week trough on the 4th of October. So I'm going to discuss that in a moment. What John is saying is that the price crossed the 18-month FLD, and I think you can see that here. Here's the 18-month FLD, the yellow line. Price crossed that 18-month FLD very definitively in early August of this year. And that generated an FLD projection. Now, an FLD projection is calculated by taking the prior high price and projecting to the cross point. I haven't done that very accurately, and projecting further down. And FLD projections are more accurate in terms of price levels than they are in terms of time. It's quite an important point about FLD projections. But the result is that you get a projection box down to here, which is, as John mentioned, at the 1050 level. 1050. I'm not going to have space to write that. 1050. Okay, so the fact that price has not achieved that 1050 level in terms of moving downwards, perhaps that sounds weird, but if price is moving down towards a downward projection, then the lower it goes, the more it has achieved that price. So the fact that price has not achieved that 1050 projection is bullish if price doesn't get that low. So that's what John is saying over there with the 1050 target generated by the 18-month FLD this summer. And you'd expect price to easily meet the target into 4.5 and 9-year lows. Perhaps John will need to extend a little bit on that. Do you think the 6-year cycle is an extended 54-month cycle, or is present in addition to the 54-month cycle? David, I actually believe the 6-year cycle is in addition to the 54-month cycle. And I can show you the nominal model that I've used to generate this. Let me do that quickly, just for the interest of those of you who are able to build your own nominal models. Here's my chart model. You'll see my longest cycle is 9 years, then I've got 6 years, then 54 months, and the harmonic ratio between 6-year and 54 months is, of course, 3 to 2. No, sorry, between 9 years and 6 years is 3 to 2. The harmonic ratio between 54 months and 6 years is 4 to 3. So there are two interesting harmonic ratios in there. The rest of the harmonic ratios between the cycles are all the same as the default cycle. So let me talk about the three analyses that I have to discuss in terms of what I think might be happening at the moment. William says, has there been any time in the past that the 6-year cycle was active? William, I haven't looked at it very far back, no. But it is the 18-year cycle is one of the cycles in Hurst's nominal model. Okay, so any analysis performed using Hurst cyclic theory, using his default nominal model, has a very clear 18-month cycle, and breaking that 18-month cycle into 3 and 6 years, there is quite a lot of evidence that cycle troughs tend to be fairly dominant on the 6-year mark, but they're generally hidden within a Hurst analysis because of course the 6-year cycle is synchronous with an 18-year cycle, of course, and every third one will be synchronous with every 54-month cycle. Okay, so the 6-year cycle is camouflaged to some extent. It's quite hard to explain. I hope you understand that. But because troughs are synchronized, every third 6-year cycle will be synchronized with every fourth 4.5-year cycle. So as a result, the 6-year cycle tends to be camouflaged a little bit. Okay, I hope that makes some sense. So let's have a look at the analysis that's been playing out recently. For a very long time, since July, now I'm going to change charts because I want to show the favorite analysis that I think is playing out. Here we go. Okay, since July, since summer of last year, I think that all of us who've been talking about Hurst have been saying, okay, there is the 18-month trough, which means we need another 2 18 months before we get to the next 54-month cycle trough that we're expecting. And everybody's been talking about there being 2 hops into early 2012. I don't think anybody out there would disagree with me that that's been the sort of general trend. Switching. There we go. So let's just measure the time since July. Our 18-month cycle hop, which is the third cycle hop that we need, is expected at about 17.8 months, which, as you can see on this chart, is right at the end of this year, end of December, 27th of December 2011. Okay, so we've been expecting. Did I say? I think I said 2 18-month troughs. In fact, we've been expecting one 18-month trough since July of last year to come down into here. Okay, of course, 2 40-week cycles to come down into there. Okay, then of course 2 20-week cycles. Okay, then what happened was that the market surprised us, or it certainly surprised me. Here we go. I think everybody was pretty much on the same page with the 40-week trough in March, and price moved on really quickly, of course, into early August, and I think many people agreed that was probably a 20-week cycle trough. And then price didn't go anywhere at all, and then on the 4th of October, somebody who is with us on our chat today, John O, published publicly, I can't remember when it was, John, was it a day or two after the 4th of October, saying 4th of October is a trough of the 10-week cycle, or the 80-day cycle. And so that's this analysis, the analysis you're looking at right now, shows that as being a trough of the 80-day cycle. I keep pressing the switch button. Set that. Okay. So this is my preferred analysis at the moment, that in fact the 4th of October was a trough of the 80-day cycle, but we've just seen a pretty extraordinary and rare sort of bounce out of that. It might be the result of what Hurst used to call fundamental interaction. Who knows, perhaps the market is just getting very nervous and price bounced further than it should have. But of course in Hurst cyclic theory there aren't necessarily any absolute rules about the shapes of the cycles. So it's not outside the realms of possibility that in fact that was still a trough of the 80-day cycle. I'd like to show you an alternative, which I think is a very possible alternative, and that is that the trough on the 4th of October was in fact a trough of the 80-day cycle, a big part of the 20-week cycle. Can you see that there? Those semicircles don't make any sense. Okay, now according to this analysis, we still have the 40-week cycle trough there in March. The 80-day cycle trough is actually positioned slightly better in June. And then the trough in August was only a trough of the 40-day cycle, and perhaps we had a few days of fundamental interaction over there. And then the trough on the 4th of October was a trough of the 20-week cycle. Certainly the move out of that trough looks much more like the move out of a 20-week cycle than the move out of an 80-day cycle. Okay, that's the second analysis I like to present, and I'm going to invite your questions in a moment, and I'll be happy to go through them again and discuss the differences. But let me now present you with a third possibility, which was actually a possibility suggested by Jose a few weeks ago in Traders Chat. Let me change the scaling of this chart, where he said, is it possible that the 18-month cycle should in fact be positioned in August of 2010 instead of in July of 2010? Okay, it's not as satisfying an analysis if you have a look at it. With the 18-month trough in August of 2010 is not as satisfying as positioning that trough in July of 2010, but it is a